Today is Friday, April 17th, and I wanted to give you an update. So, as we continue in this pandemic and these unprecedented times, I hope you're all well and healthy. I know a lot of people who are impacted greatly by the economic shutdown brought on by this pandemic. Really unprecedented times. But there is some light at the end of the tunnel. There is more and more optimism that we're going to come out of this, that we're going to get back to work and open across the country. We initially thought, and everyone hoped, that it would be what we'd refer to as a V-shaped recovery. Right? We had the decline and then a lot of panic, but then hoping that it would very quickly rebound. No one is really thinking it's going to be a V-shaped recovery. It's more of a U-shaped is what we believe. So it's going to be a little bit slower, take a little bit more time. But we have made a partial recovery, and there is a lot of optimism towards stocks specifically. Now, all stocks are not equal, right, in this environment, and so our portfolios are being adjusted away from problem stocks to those that flourish in this type of environment. So one of the biggest concerns that I see, well, it's both a negative and a positive, but it's the low interest rates. So from as far as bonds go, the 10-year Treasury yield is just a fraction of 1%. As of today, it's 0.6% yield on a 10-year Treasury bond. Very, very low interest. And so investment portfolios, many of them are heavily weighted in bonds because of the volatility, but then they're just getting really no return or yield. And so I'm a big advocate for alternatives to the bonds. As many of you already know, some fixed index type products and whatnot for the conservative portion of a portfolio. But the stocks, just the dividend yield on dividend paying stocks, is around 2%, which is significantly better than you can get from bonds. And so holding stocks for the long term is really a good option, but I'm very bearish on bonds. So that's not new to a lot of you who are familiar with some of the things we've talked about and discussed in the past. We do have this, our national debt has surpassed 24 trillion now. There's going to be more and more printing of money and quantitative easing, which runs the risk of higher inflation down the road, and certainly a risk of higher taxes down the road. So we think and we hope we've got a really good next several years still, where taxes are low, opportunities to take advantage of Roth conversions are very good. The CARES Act stimulus has created some opportunities where you could, for people who are 59 and a half or are younger than 59 and a half, and they have money in their 401k, they're actually able to pull some of that out without the penalty that is normally there. And I'm going to actually make a video where we go into the details of that and who might benefit from that. But for any of you that have specific questions for me, please always know that I'm available. Don't hesitate to reach out to me with any questions that you might have. I wish you the very best through these trying times and hope you have a pleasant, enjoyable weekend.